Hello everyone, this is Accounting Made Simple with Akim. Today I'll be talking about investments in associates. IAS 28, investment in associate and joint venture. So I'll be focusing more on an associate, then maybe later I can do a separate video on joint venture. Talking about investment in an associate, what is an associate? We need to understand what an associate is, then what constitutes an associate. What are those things that will show that an investment is an investment in an associate? An associate is a company where an investor, if you see it here, um, in line with IS 28, an associate is a company where an investor has significant influence on. So when we say significant influence, what does significant influence mean? Um, the standard goes further to explain what significant influence means by is the power to participate in the financial and operating decision of another entity. So um, what's how can we say you have the power to participate in the financial and operating policy decisions of another entity, that is of another entity, let me add that, of another entity. Yeah, that's it. So it can be by way of representation on the board of directors. Board of directors. Yeah, that's it. Then it can be by participating in policy making processes, including uh, distribution of dividend in the entity. It can also be in the form of having material transactions between the entity and the investee. A transaction can be maybe a major sale and purchases agreement over a period of time. So, like that's we can say that entity has significant influence over the investee. Another way of having a significant influence can be by way of interchange of managerial personnel, or can also be provision of essential technical information. So, in all those cases, we can say that entity has significant influence over the investee. It is expected that when you are talking about significant influence, we need to also look at the quantitative aspect of it by looking at what percentage actually would constitute significant influence. So IS 28 um, stipulate that if we have 20% or more, but less than 50%. The reason why the standard says this is because if you look at our explanation when I was talking about IFRS 10 consolidated financial statement, we say that when an entity has 51% or more, or sometimes on a special purpose, that's another discussion. So we talked about having 51%. That is the way to say we have control. But anything below 51%, but more than 20%, the standard says is an associate. But this condition has to be present before we can say is an associate. So we'll be assuming, for the purpose of the discussion that we'll be having under investment in associate, that any investment that has 20% investment that is 20% or more, but less than 50%, so that that entity will not be having control but only significant influence. So that is investment in associate. So how do we now account for this investment in associate? Um, the standard stipulates that we should account for it using what we call equity method. Equity method. Um, 1 minute. Equity method um, accounts for the actual investment in terms of the cash paid for the investment, as well as changes that impact that investment over a period of time. So, and if you notice under IFRS 10, we talked about consolidating accounts line by line. I mean, merging the account of the holding company and the subsidiary in terms of the asset, non-current asset, and other things, and liabilities too. We merge it line by line. We had it line by line. But under the equity method, we look at the actual cost of investment. I mean, the initial cost, the initial cash or consideration paid by the investor in the investment or in the investee, as well as changes. What are those changes that would impact over a period of time? So in this one, we can be looking at um, one can be maybe profit or loss. Yes, we can be looking at dividend payment. Maybe if there's any unrealized profit um, as a result of a transaction between the entity, it can also impact it. Another thing that can impact it is maybe there's any impairment in the investment. Yeah, impairment in investment. So all these will say uh, falls under the equity method. So let's try an example that we have here. The example that we have here shows that 1 minute example. So let's look at this example. It says company A acquires 35% of the shares of company B for $100,000 on January 1, 2023. On 31 December 2023, company B, sorry, company B made a profit of $30,000. So when we talk about those things that will impact um, that investment over a period of time, profit or loss is part of it. So we can see from this question that company B made a profit of 30,000. So this one is expected to impact that investment when we are measuring it. Um, the question goes further to say company B paid a dividend of $5,000 for the year. So dividend is also part of what we mentioned up here. So that will also impact that investment. During the year, the investment of company A in company B was impaired by $15,000. So impairment of investment was also mentioned as those things that would impact that investment over a period of time. So um, let's look at the solution. So how do we tackle this? The first thing we need to do is to look at when the uh, investment was acquired. It was at 35%. If it's not mentioned, maybe number of shares mentioned, what we only need to do is to calculate the proportionate of the shares of the investee. So then we can know the percentage. But it's given here, so we don't need to waste our time. So we look at the T account, I mean in terms of the debit and credits. So what account do we debit, what account do we credit? So the first time when we buy the investment, I mean purchase that 35%, we'll be looking at debit investment. That is the initial, let me say, initial recognition. Debit investment. How much is the investment they were debiting? $100,000. Dollars here. Dollars here. Um, So what account do we credit? Is that bank? It's never mentioned. Maybe bank or maybe payable or anything. But let's use bank. So 100,000. That is when company A buys that investment. So then subsequent measurement now. We now need to start looking at subsequent measurement. So we need to look at what has impacted that investment during that period of time. So so when you have an investment, let me do a pro forma. So we have initial investment. Um, the formula is, let me just do a pro forma first, and I can say exercise add profits on no add is percentage share of B profit. So let me use that word. So excess X. So the next thing is, let's if there's any impairment, let's say, yeah, there's impairment. Yes. So also the fact that um we talk about dividend received, because the holding company will have the investor will have received a dividend of certain amount, and I'll tell you why we are deducting that dividend is because if you look at this profit that we have here, the profit of $30,000 that we have here will have included this $5,000 dollars paid as dividend. So if we are not removing it, we will be double counting it. So it's better we remove it here, but will not show it in the profit or loss of the investor. So so let's start putting everything line by line. So the first thing is initial investment, 100,000. What is the B share, company A's share of the profit? We say it's 35%, and that profit that the company made in that period is $30,000. So when we take 25%, 35%, sorry, 35% of that $30,000, then it's 10,500. So what is the impairment value? So that impairment value, we will not be looking at percentage of the impairment. I'll tell you why we're not looking at the percentage of the impairment, because the impairment that we're talking about is the value of the investment that we have in company B. We have impaired that value. We are not looking at company B holistically. We are looking at that investment that we have. That means the proportionate investment that we have. That investment has been impaired. So that value of 15,000 is what is coming from 15,000 from that investment itself alone. So, and we talk about company B paid a dividend of 5,000 for the year. That 5,000 dividend that the company P paid has gone to both the holding company and the subsidiary. So that's the difference between that one, because that one is like also taking a percentage of the profit that we have here, which is A's percentage share. So we're looking at that percentage share of that dividend also, not the full amount. So what is that amount? $5,000 times 35%. So then when we do that, so we have the investment in This is the value of investment in company B. That is subsequent measurement. Bold the line, bold underline. So when we first of all buy investment, that investment value as at 1st of January, that is 1 January 2023, but as at 31 December, December 2023, that value has reduced. So this is the value that will be showing in the balance sheet as at the year end. Talking about this investment in associates, there's something that I need to let you understand, that when we're talking about investment in associates, this value that we have here, I mean, in terms of the share of profit, let's assume that after this year, I mean in 2024 or 2025, company B made huge loss in its books. Company B made huge loss to the extent that that loss has affected the investment to a negative value here. Let's assume the loss that the company made. Let me see subsequently. Let me say everything remains the same. Let me just do that scenario here. Everything remaining the same, except that company B made a loss of let me say for instance 300, no, let me say $300,000, a loss of $300,000. So that will be loss of $300,000 times 35%. So let's do a sum of it. Can you see that that loss has impacted that value to a negative value? So what the standard says is that we can never have, under the equity method, a value of the investment of less than 0. So what we'll be doing is taking a value that would only result in 0 as a net net value of investment as at the end of the year. So what we're doing is we are adjusting that 21,750 on this value here. 21,750 plus 21,750. So the share of the loss that we'll be posting in the box will be 83,250. So that is how we will represent it when we have a negative value of investment as a result of the huge loss in the investee. So this is the value that will be represented in the balance sheet. So what happens to the provisions, the profit and loss account? So if you look at it here, we have debited we have let me see, debited investment here, investment with 10,000, which is this 10,000 that we have here. What account do we credit? We credit profit and loss account. What else go to the profit and loss account? We have 10,000. No, there's another one, impairment here. We have credited investment because the negative value of impairment with that investment of 15,000. So what account do we debit? We debit profit and loss. For that same value. The next thing is the dividend. So the dividend is a bit different, though we have credited investment with that value of 1,750, what account do we debit? Because we have also used it to adjust that investment. So we need to debit an account. Debit. So the account that will be debiting is not profit and loss. Is either is bank that we have received that amount 1,750, or if that amount has not been received, we have dividend receivable. So we can say a receivable account. You understand? So that is how we treat investments in associates. Thank you.